Hey guys, welcome back to the channel. My name is Timothy, and on this channel we speak everything personal finance. And in today's video, I'm going to be giving you a simple investor guide. Now, before we dive in, I do want to go over the fact that many people think that investing is too complicated. And trust me, it's really not as confusing as you think. And people also think that you need a lot of money to invest, but nowadays you don't need a lot of money to invest. So start small, and over time, your money will grow significantly. So let's get right into it, with the first step being start early. The earlier you start, the better. You can start with investing 1% of your income or 5% of your income. It doesn't matter. Just start with what feels comfortable to you. So if investing 1% of your income is comfortable to you, then start with that. And month by month or year by year, you can increase that percentage by 1%. So if in 2024 you invested 5%, then in 2025 you can invest 6%. You might have gotten a raise, and then you can increase that investment and invest 6%. And what do I mean by starting early? I'm talking about starting young. Start investing as early as possible, and I want to give you an example to really drive the aspect of starting early home. So imagine you start investing at 25 and you invest $200 a month with a 6% return on your money. By the time you reach 65, you have $395,000 saved. Now, compared to someone else that started investing 10 years later at 35 years old, they'll have about $200,000 saved. That's a $200,000 difference just because you decide to start early. The main point here is to start investing early, even if it's small amounts, because these small amounts will begin to grow and compound on each other. You'll have decades and decades of investing, so the earlier you start, the better. So go and start early. Now, I did mention how you can invest 1 to 5%, and the second step is to decide how much you actually want to invest. Now, like I said, you can invest 1 to 5%, you can invest 10% of your money. It's all up to you and your preference and what you can handle. You might find that you can only invest 5%, because if you invested 6%, then you might not have enough money going to your bills. But you might find that by the end of the year, you had enough money going to your bills, so the next year you're going to up the amount you're investing to 6%. And the year after or the month after, you can go to 7%, and so on and so forth, until you can find the maximum amount that you can invest. So for me, I had to find that number. I changed the percentages of how much I invested to my 401k many times. I started at 5% because that's the match that my company gave me. And then I realized I had a lot of money that was being saved. So then I upped it to 8%. And then I realized I was still saving a lot of money. And then I was at 10%. And then I found the sweet spot at 15%. Because I even went to 20 to 22%, but I realized that was just too much money. So I found the sweet spot at about 15 to 17%. I kind of just hover around there. And then maybe every 2 years I'll go up a percentage, but not every year I won't go up a percentage. It's personal finance. It's really up to you how much you want to invest and how much you want to increase your investments as time goes by. And if you want to figure out how much you can invest, then you can do this. You can write out all your expenses on a piece of paper, put it in a Excel document, and just add up how much your expenses are. How much are you paying in rent? How much are you paying in insurance? How much are you paying in groceries typically for a month? How much is typical entertainment for a month? How much are you paying in gas for a month? And then you subtract your net pay from your expenses, and the leftover money is the amount of money that could go to investments. So if you make $4,000 a month and you really only use $3,000 a month, that means you have $1,000 left, or 25% of your money can be invested or saved. So the most important thing here is to invest something. If you can't invest 10%, invest 5%. If you can't invest 5%, invest 2%. If you can't invest 2%, invest 1%, and slowly increase month by month or year by year. So start small if you need to, but the key to investing is to be consistent in what you're doing. So have money automatically invested into your retirement accounts. Step 3 is going to be open an investment account. Now, I know there are so many different investment accounts out there, and you might not know which one you want to choose. So I'm going to give you some options of investment accounts that you can choose from. So you have your brokerage account, which is a general investing account where you can put however much money into it that you want. You can take that money out whenever you want. So if you do take money out of the account, you're gonna have to pay taxes on the money that you earned from your investments. A lot of times you can use your brokerage as a bridge account to kind of substitute some money before you reach your retirement age. You also have your 401k, which is an employer-sponsored retirement account that comes out pre-tax. A lot of times this money gets automatically invested to your company 401k, and you have a list of funds to choose from, and then you invest to these funds. So for an example, in my job, we have funds that are similar to the S&P 500. So I put all my money into those funds, and they grow at the same rate of the S&P 500. So that is your 401k, your pre-tax retirement account. And then you have your Roth IRA, which is what a lot of people invest into for 2024, the maximum that you can invest into a Roth IRA is $7,000. This money is put in post-tax, unlike the 401k, which is pre-tax. This is post-tax money. So this is money that goes to your checking account. This is money that you take home. You put this money into your Roth IRA. You have to choose an investment that you want to put this money in. You take that money out tax-free without penalty at 59 and a half years old as of 2024. What do I mean by tax-free and without penalty? Say you have $1 million in your Roth IRA and you reach 59 and a half years old and you say, I want to take $1 million out. You can take $1 million out and you won't have no penalty on it. You won't have any taxes on it because you already paid the taxes on it before you put the money in there. Now, if you did take this money out before 59 and a half, you will pay taxes and penalty on that money. And one of the rules you can go by is to invest into your 401k match. And then once you invest to your match, you can max out your Roth IRA. Then once you max out your Roth IRA, if you have money left over, you can go back to your 401k and max that out. And then you can look into investing into your bridge account, or you just invest to your bridge account. And it's really up to you and whatever your financial goal is. And the fourth step is to pick an investment strategy. So if you have a time horizon of 20 to 30 years before you retire, you may want to invest into more stocks or just investments that grow at a higher rate than investing into something like bonds, which don't really grow, or keeping all of your money into a high yield savings account, which in 2024 is growing at 4%, which is still good, but that money can be grown at a higher rate if you invest it into the stock market. Now, by choosing individual stocks, this can be a lot more risky. So you have to kind of see what your risk tolerance is. Are you a more risky investor, or do you like less risk and more of a certain financial future? That's up to you to decide. So if you want a simpler strategy, you can invest into index funds, mutual funds, or ETFs, which are exchange traded funds. So these investments spread money over a wide range of stocks. They lower your risk, but also give you strong returns. So something that you could put your money into is the S&P 500, which holds the stocks of the top 500 companies in the US. Now, the S&P 500 has given a historical return of about 10%, and right now it is on fire. So this is a great time to invest into the S&P 500. But a 10% rate of return is amazing for your portfolio. So say you started investing at 25 years old and you invested $500 into the S&P 500 that has given a historical return of about 10%, and you did this for 30 years, you have just over $1 million in your retirement account. And that's just from investing $500 into the S&P 500. So really where the simplicity of investing comes in is by putting money into simple investments. So the S&P 500 is one of the simplest investments that you can do. So if you're on Fidelity, look up the S&P 500 for Fidelity. If you're investing in the Vanguard app, look up the S&P 500 for Vanguard. It's a super simple fund to invest into, and the returns that you're going to get from it will most likely be better than the returns that you'll get from anything else. And this is something that I do. The majority of the money that goes into my investment accounts go to the S&P 500. Now, I do have some money that goes to individual stock, which is good to have as well, because I will be retiring in about 22 years. So I have a long way to go before I actually retire. Majority of my money is into the S&P 500 because, like I said, it is a almost guaranteed return of about 8 to 10%. And of course, it depends on the year. The S&P 500 could be down, but generally the S&P 500, it's a good fund to invest in. And the fifth step is stay consistent and track your progress. Consistency is really key when it comes to investing. It's not about how much money you have in there right now, but how much money you're able to consistently invest into these accounts and how it grows over time. So once you start, aim to make consistent contributions to these investment accounts. So no matter how small, just continue to invest into these accounts consistently. When you're starting off, you're not going to see it grow as much, but as you get more money into these investment accounts, you'll see compound interest begin to work because the money will build on top of each other. And before you know, you'll have more growth from this money than what you have been contributing into these accounts. So for us, we have half of our paycheck going to our savings account. And then out of that savings account, we have a certain amount of money that's going into our investment. So automatically that money is taken out of the savings account. It's invested into our brokerage account. It's invested into our Roth IRA. And then we already have the 401k coming out before we even see the money in our paycheck. And then when that money gets into the brokerage account, when that money gets to the Roth IRA account, it's automatically invested into the S&P 500. It's automatically invested into individual stocks. It's automatically invested into these ETFs. So it really makes it easy. It's something that we don't have to think about. We're investing consistently every month without moving a finger. It's so funny because I'll go out, I'll get an email that says $400 has been pulled pull from your account and invest it into your retirement account. I was like, oh, okay, sounds good. And I didn't have to do anything to get that money there. It'll just automatically invest it because my life is on automation, and automation is something I talk about all the time. You need to have your life on automation. So that's it, the 5 simple steps to investing. Start early, decide how much to invest, open an investment account, pick an investment strategy, or invest into a certain stock. And then 5, stay consistent and track your progress. By following these steps, you'll be on the way to build a successful financial future, especially if you don't know where to start. If you have no idea about investing, follow these steps, start investing today, because the earlier you start, the better. Just remember, the most important part about investing is just getting started. Just invest something and don't wait for the perfect time to try the market. Just get your feet wet. Just get some money into the market and watch your investments grow. I hope you guys enjoyed this video, and if you did, leave a like on my channel, and I'll see you guys in the next one.